Something big happened last week and you need to know about it. The Federal Reserve's steep decline in interest rates at 0.5 percentage point has created a flurry of controversy about whether Jerome Powell is expecting a recession, and I think there's wisdom we can salvage from economist Ray Dalio's words. This is not financial advice, but subscribe to the channel and listen to what he said just a few days before the Fed's announcement last week before we get into it.
The debt, money, economy, dynamic and force. Okay, so we have a big debt increase. We have an enormous amount of debt, and it's going to keep increasing, and one man's debts are another man's liabilities. Okay, so what is that going to mean for monetary policy? Okay, as you have to sell more and more of those bonds, what will be done? I think the same thing was done in Japan. Though that what happens is there's not going to be a default. Of course there won't be a default. But increasingly they have to drive down real interest rates so that real interest rates are significantly negative. So you're going to have, in order to service the debt, you have to have a significantly negative real rate, and you also have to have then the depreciation of the value of money because inflation rises, so that you have to have a nominal growth rate, in other words, inflation plus real growth, that is above the nominal interest rate, and you have to have a real interest rate that is negative, and you have to have a positive slope yield curve so that holding bonds is a bad deal.
Now remember, Ray Dalio said this is just prior to the Federal Reserve announcing it has slashed the interest rates by 0.5%, so there's a benefit of hindsight we now have. For nearly 2 years after the pandemic, interest rates had stayed at a level of almost zero, followed by a sharp rise. And now, despite the fact that many experts, include Ray Dalio, kept calling for a soft landing, we've got a pretty big drop in interest rates announcing on the 18th of September. So what does that do? Well, Warren Buffett is sometimes likened interest rates to gravity in an economy, and it makes a lot of sense in this context. A sudden drop in interest rates makes credit much cheaper to access for both individuals and corporations. In turn, that increases the purchasing power temporarily, leading to a buying and spending spree. And what is the first effect we're likely to see? Well, it's the revival of a housing market that has been going through a slump for some years now, as more people decide to buy houses or make other large purchases. But is that really advisable at a time like this? Ray Dalio seems to think that a rapid drop in the interest rates could mean that the Federal Reserve anticipates a recession in the next few months, and wants to stave off a period of economic slowdown by encouraging borrowing and spending. But that's a double-edged sword, because in case we do in fact see a period of recession, then the Federal Reserve may have shortened the window for its most potent monetary tool, which is the interest rates. And if you look at things like the historic high national debt or inverted yield curve in the bond market, there's ringing alarm bells for economic slowdown, where being fiscally conservative would be a much better approach than shelling out money on big purchases. And to top it all off, there's more volatility expected after this presidential election as it regards the corporate tax rates and what that means for the consumer price index.
Then the question is issues of taxation, and those issues of taxation will have an important impact on the capital markets. If they're bought for after-tax returns, by and large, it's the important thing. You lower corporate income taxes, you raise corporate income taxes, it makes a difference to prices. So we're going to have those issues, a lot of issues to talk about regarding the election. I think when we go beyond that, most likely, there is going to be irreconcilable differences, and I think that you're going to see more movement to states. So there'll be a challenge of what does the central government control, and what do the state governments control, and is there an obedience in a sense. So we are coming more to a fragmented set of circumstances. What we would need, I think, is strong leadership of the middle to bring the country together and isolate more of the extremists, if that was possible, and then to make reforms, because we do have a very skewed type of economy.
That's why Ray Dalio's approach is a bit more conservative on both ends, not just with interest rates, but also on taxation and debt. If the Federal Reserve squeezes itself into a tight window with a sharp cut in interest rates like this, then that solution only gives rise to more problems. Because think about it, other than adjusting taxation of interest rates, how many other broad-based methods are there to get a lever on the economy in times of recession? The only thing left to do at such a point is a short-term solution with long-term pain, and that is printing more money. We're already barely adjusting to the inflation from the money printing after the pandemic, and more loss of our purchasing power will only make things worse, especially when the rising national debt and interest payments force governments to think about rising taxes to service previous debt. And you see Ray Dalio's approach here carry over to the international sphere as well, just because of how much leverage foreign nations have gotten as a result of holding a significant chunk of America's total debt.
I just want to be clear about the investing in China. In all countries, there are cycles and ups and downs and so on. And in no country should you invest so much money that it becomes a dominant portion of your portfolio. So in China, I still invest in China. The question is the size of the investment and how that investment is structured.
And that's a China that itself is slowing down after decades of being the world's engine of economic growth. Right now, China alone holds more than $770 billion worth of America's foreign debt. And while there are certainly more and bigger names on the list, China is the only one that's a hostile power to the US. Japan also holds over $1 trillion, and they've already demonstrated how closely tied their economy is with the US with what happened in the first week of August. Some experts are even expecting a potential recession or crash as the result of the AI market, which many believe is a bubble, much like the dot-com bubble 25 years ago, but the technology itself may be here to stay. It's not hard to imagine that a rush of hysteria in the last few years would have given rise to companies and investments that will eventually fail, so such a scenario may only require more bailouts and in turn, more government debt.
It sounds to me you're also arguing that if we're going to have a soft landing, that maybe people are going to feel more comfortable holding as much debt as we do and that the rates are not going to, blow through the roof.
No, I think we're talking about the short term as very distinct from the longer term. The short term we just talked about. The longer term is that we are at a point in which we are borrowing money to pay debt service. And there is a process by which when you keep having debt growth faster than income growth, then that means that you have debt service encroaching on your spending. That's the same for the government as it is for us. And as that happens, and you want to keep spending at the same level, there is the need to get more and more into debt. And the way that works, it's like it accelerates.
That's the clearest explanation of how governments have dug themselves into a quicksand of debt over the last few decades, and combined with the economic and global peace indicators and a sign of a potential recession in the coming months, should make people rethink their investments and spending strategies moving forward. As always, it's people that are ahead of the curve that come out ahead, and Ray Dalio's words help make that happen. Let me know in the comments if you agree, because we may have to put his words into action in the next few months.